Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, January 18th, 2023. It is 12:29 p.m. Eastern Time as I'm starting the video, and we're going to stick with the equity markets as well as some individual stock trade ideas. I'm going to cover some new. We'll go over some stocks. Some of these are more for analysis on the broad market. I'm going to go over some of the components of the S&P and the Dow. I've been talking in recent weeks. I made it very clear at the lows I was most bullish on the tech sector. I thought we'd see a resurgence back into the beat down former beloved FANG stocks, the big tech, Apple, Microsoft, Amazon, Tesla, and the likes. And that's what we got. Now, where do we go from here? I'm going to talk about that a little bit about the rest of us, the rest of the stocks. I'll get to that in a second. What I'm referring to, the Nasdaq 100. Oh, before I do that, I want a quick update. Yes, I am still aware of and working on the issue when you click on a symbol tag on the site that is below the post. There are tags, and there's also categories such as trade ideas, long trade setups, short trade setups. I don't always keep those up to date. Every now and then, I'll go in and make sure I purge out some of the old trades are closed out, but it kind of gives you a view if you want to get in there, look at short setups, long setups, active trades, things like that. Again, I'm working on that. I'm waiting to hear back on a programmer that can get that fixed for me. It's beyond my capabilities. I tried to troubleshoot and get it fixed, so we'll get that working as soon as possible. Of course, the site's functional as far as coming in, reading posts and all that. It just helps to the tagging feature is great because if you're, say you're just catching up or you're new to the site, you want to see what I, last analysis on Apple or anything else, click on it on the tag. You can also queue those up in the under the resources page. There's at the very bottom there, you can search by any ticker symbol, Bitcoin, whatever you're looking for, and then all the posts are there in chronological order. So we'll try to get that fixed as soon as possible. All right. To the markets, and then I'll get to these individual stocks. Also had a request for Ford. I'm going to get you that as well. QQQ. All right, so really no change. We went above 280, but as I said, this market you almost have to, well, you do have to incorporate into your trading plan if you expect a reversal at X. Give it to X plus something, because it's about the only, the most consistent thing we have in this market are whipsaws. Again, whether it's the nefarious forces that be, the big market makers, the big trading firms, trading desks, algorithmic trading programs, they know where the stops are, and they like to run them. And either way, anyways, I won't beat a dead horse. I've made it very clear that I was given a little room on those shorts. And now what do we have today? We finally have what looks like as good a sell signal as we get. If you recall yesterday, I said we needed to see, we had the divergence. We've had divergence since we hit that 280-ish target right there, 280.16 on the 60-minute chart. Went up a little, not very impulsive, gapped up today, kept the divergence very much intact. That gap, the only thing technically it changed is it just extended the divergence even further from where we closed yesterday to here. Now we have a clear, we have a bearish PPO crossover. It's hard to see. I have my PPOs flattened out a little bit there, but there it is. There's what your divergence looks like. And impulsive selling, and then as I said yesterday, you'd want to see break that back down below 280, and then that makes this a whipsaw, false breakout, bull trap, whatever you want to call it, as long as we remain below there. Now the day's not over. That candle, for all intents and purposes, closed right on 280. This candle's still forming, has another half hour to go, so we could get back above there. And if we do, doesn't mean that then this was a bear trap, because you want to see a solid 60-minute. If we go down here, get a solid 60-minute close below, go down there, and then go back up, well, hey, that's going to be pretty bullish. But right now, this is what happened, and this is still what I expect. No change, a minimum pullback to at least 274.61, and based on the long-term charts, there is still very, very much a possibility that this counter trend rally may be over with the next leg down to come. So how you trade it is up to you. One option, if you shorted 280 or above or scaled anywhere around here, set your stops appropriately and commensurately with your targets. What I mean by that, if you're an active trader and you're only looking for a pullback to 280, 275 or so, you want relatively tight stops. You have at least a 2-to-1 risk-reward ratio. Risk a buck to make two. But if you also are targeting Downside here, which is my next downside target, and for the bear market, about 235. That's going to be another from below the 280 level. That's about a 16% drop. And I did reply to some of the recent comments I caught up on, and somebody asked about this. Someone who had been short since November, and they didn't specify where. Back in November, which is right here, I had laid out this what I called most likely bounce target zone. I highlighted the pushes to the bottom of the zone as well to the middle. Again, you don't see it on the daily candles because that was in pre-market. We had a big move up in pre-market that got faded before the open, so it's not reflected on the closing candles for the day, but that's where it was perfect entry, as good as it gets, right into those 200-day moving averages, the exponential and simple, and the primary downtrend line. So where I was going with that is that average cost on that swing or trend short trade would be about 300. And so if you look at it from 300, and again, this is all detailed in there because this person said, hey, what do you recommend? I can't give specific investment advice, so I gave a few examples. If you shorted that back in November, the rally back to the 200s, and you're in for around 300, well, the drop from 300, even though you've given some back and felt a little pain on this bounce, you're still profitable. Number one, we're at 279, so that's still a very profitable short trade, and it's about 20%, 21% if we are going down to 235, and so therefore that person could have a much more liberal stop, looser stop, or protect profits. There's no reason to give back a nice all your profits. Now you can set a break even, you can set lower stops to assure profit. Again, that's how you want. Now on the flip side, if somebody else only shorted here 280, but they are also, let's say they did what I did. I'm been short since the 200 days down to here, was planning to stay short, and then told you flipped and decided to go long and remove my hedges. And I'm sorry, I had hedges, removed the actual index shorts and gamed the bounce and gamed up to there. Now that person can either be an active trader and go for a quick pullback trade. I'm a little unsure where we're going. Near term, I just feel more comfortable gaming the short-term charts now, taking quick profits, and waiting till I have stronger convictions of where the next intermediate term trend is, and that means weeks to months. Right now, I'm focused on where we're going in the coming days to even hours. That's short term to me, hours to days. Intermediate term, like I said, weeks to months. Long term was 6 months to a year or more. And I'm still long term bearish. Intermediate, little uncertain. We could certainly get another thrust up, as I've covered. And where I was going with that is, let's say you gamed this rally. You're a pretty flexible trader, long and short, and you do think there's a good chance we're going to undercut the lows and head on down and have another thrust down, another major leg down the bear market. Well, then you can have a stop somewhat above there and just let it ride down. Your check marks are going to be if and when, especially this box here gets taken out. If we come all the way there and we get a pretty deep pullback and test the top of that range, that may be an objective long entry, and the markets could rocket from there. But if we fall back into that range, the markets right now, in my opinion, that was a basing pattern right here, and you can see it on the daily. The markets have, if the bear market's over, or we're going to have a much more substantial rally, even if technically the bear market's not over, if we're not going to take out the old highs, where I'm going with that, we could still have a decent rally, and in my opinion, the markets have no business taking this out. We've had several. The Qs have flirted on that level 3 different times. This one lasted a couple weeks, building a lot of energy. So again, we undercut those lows. Even that you get into the range wouldn't be at this point healthy. You'd probably do that. So there it is. So that's kind of bigger picture stuff. Bearish, and as long as we hold above that level on a back test or a pullback, or maybe not even get there, there's still the chance we could run up and at least hit the 200-day moving averages again and the downtrend line. So that's it. But like I said, I'm just more comfortable active trading right now than positioning long or short for a trend trade. In other words, 401k type monies is a good example. A lot of restrictions on 401ks where you can't move in and out of certain funds too often, and those are the ones where I yeah, I don't have a strong opinion right now. Okay, well I'm on the Qs. Let's just rifle through the fangs, the big components that make up QQQ. This is Apple. Apple still has some really significant downtrend lines, a secondary or BOD benefit of the doubt there, and then the first one comes in right there. We're very close to that. You also have, as you can see here, negative divergence, about equal highs on the RSI there, lower highs, and that gives us this when you zoom in a little tighter. Most important level right now on Apple, and also look at the other fangs as well as that uptrend line. So I just showed you QQQ broke down, but Apple right now you can see it's pretty well defined. And so to get a real correction going, maybe this pullback gets bought up right here. I'd be surprised if the Apple dip buyers don't step in here, but if they don't, they take that out. And then they take out next support just below 134.61. Then we're probably going to see a deeper correction. But as of now, like I like to say, support is support until it's broken. So that's a level to watch, man. I even set an alert there to kind of give me a heads up. And next up, Microsoft. Added a new trend line today. This one here, right there, that gives you this bearish rising wedge, complete with negative divergences on the 60-minute chart. Looks just like QQQ, right? Breakdown, impulsive red candle. That's a solid check mark. That's a solid close, break and or solid close below, followed by another red candle on support, holding that support now if that gets taken out. And again, it's all, Microsoft's not going to do this or this unless Apple does this, right? So, Microsoft might crack that support I just showed you, but then Apple steps in here, or the buyers step in and buy Apple, and then all of a sudden the futures start getting bought up because Apple's the biggest component. Microsoft, Amazon, no change really. That was at least me personally closed out because that's my near-term target was the downtrend line and these intersecting resistance zones here up to about 98, and we're still where we're at. You zoom in real closely, and we had an uptrend line that's now been taken out. There's a pretty clean uptrend line on the 60-minute chart. Today's little pop into the highs, which got faded, finally gave us what we were lacking before. Last couple days, and one reason maybe the market didn't roll off the immediate tag of 280 on QQQ is we didn't have negative divergence on a lot of these fangs, which we now do. So there's Amazon. But if you want to look at the glass half full, I just gave you the glass half empty with the at resistance, negative divergence, but we're still at the same resistance zone. And if you want to look at it glass half full, just like Apple, they may come in and buy this, pull back to the trend line that I showed you on Apple. Well, look at that. Amazon overshot and is currently back testing the uptrend line. So if this whole thing proves to be a breakout and successful backtest, and the buyers can start moving in, take out 102 right there. That's resistance about 102, maybe a little higher. I'll add another line here. I should, because we have a spike high there and a couple highs right there. Really about 104 for smooth sailing. There's a big old gap there. Then that's going to be bullish and probably give us some more upside and see the Qs take a run at the 200-day moving average that I showed you a minute ago in the primary downtrend line. However, if we break this trend line, then this whole thing is a failed breakout, aka bull trap, and that'll probably send Amazon back down to what was my, on the upside 90.36 target there. And like everything, it's got a big basing pattern there that should not be violated at this point in time. Best case bullish scenario, or worst case, bullish scenario, would be a pretty good correction back to test the top of these ranges in QQQ and Amazon, and then buyers step in and do that. Anything else is not going to be pretty for the markets, in my opinion. Alphabet, I'm going to tweak this trend line. That's the GOG. Where's my other share class? That's the one the Class A shares usually is where I keep this chart up a little more. There's trend line. My other line should populate here shortly. There they go. All right, let's take the extra one away. Little divergence there. But like Apple, pretty well. It's not a great trend line, so forget about that one. Most important trend line is this one that comes in off the highs, just like Amazon and so many of those other big fangs. So, you start to take these out one by one, and that's going to be bullish and probably run you up to the next resistance level, which is about 100 on Alphabet, give or take. One more. Let me go back to QQQ. Saw my components load, and I wanted to cover Tesla. Here's a great example. Threading the needle on this one. There's that tag. I got out to you in pre-market before the market opened, and then I followed up in that post in post-market. If you, for some reason, you don't know how to trade in pre-market or don't want to do it, you had an opportunity at the open. Look at that. The high of the day was 136.68 versus my target of 136.34. Close enough for government work. Get out of there. Like I said, the odds for a pullback were likely, and there's a pullback so far, so you were able to if you're still long holding out for more, at least at this point you sidestepped a give back of about 6%. So you could buy it back now, or it's in no man's land. I'm going to say that now. This is where I think let me find that chart I put up there. One sec. Okay. As a follow-up to the Tesla post this morning, which went out in pre-market shortly before the open, I posted this one saying that there it is in the regular session that was hit, and showed this is kind of what I'm seeing, something along these lines. You get an initial pullback. They already backfilled the gap, and then a little had it bouncing maybe when they step in by the gap, and then come down here. So all I can tell you, I don't know if we're going to get down to 123 or if we go down there and slice right through it, but that's 123.44, so call it a little north of that, say about 124 is where the next objective long entry would be on Tesla. Even if it popped 136 today, it's a little too overbought for my taste, so I wouldn't re-enter. If we do get some more upside in the coming weeks and the intermediate bullish case firms up, then that's still a potential move up there at about 167.53. But in the setup I gave you, we were down here on January 4th. That was where I had us going, and that was my intermediate term, near term target, and that's been hit. So right now the RR is just no longer favorable in my opinion on Tesla at this point in time. Okay, now the much anticipated Ford update. Had a couple folks that wanted an update on Ford, and I apologize. I try to come in there from time to time and catch up and get to replies. I don't, what, that one actually, I think it was only from yesterday. It wouldn't have mattered because the move already happened. Here's what I would have said. I had Ford at a downtrend line. You can see Ford, like everything's in a bear market, downtrend line resistance. I can say this, if we weren't in a bear market, this would be one of my top picks. A setup now. Make that clear. I wouldn't buy. You had an uptrend line. I'm going to get the 60-minute chart right there that was broken. Ford trades very well to the technicals. You can see these uptrends, and they break, and then you get a downtrend. You had a primary downtrend here. That wasn't just a downtrend line. You had positive divergence, aka bullish divergence there at the low that gave us this rally. And these are big moves, from 10 to 16. That's a 60%, almost 70% rally. That last bull market ended with a divergent high and a trend line break. So again, you can see the simple stuff: divergent high, correction, or bear trend, whatever you want to call it, big drop. What was that from the highs? First drop there was about 60%. Yeah, I think you can call that a bear market, followed by a rally. Again, it's not drawn here, but you got it. There's your negative divergence that said, hey, maybe time to start taking some profits there. And you also smacked right into the 200-day simple moving average. That blue line there got rejected, and that's a great moving average to use in bear trends. Look, boom, 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 boom. Couldn't make it. Boom, last attempt, rejection finally. So the bulls were knocking, trying to break that 200. Couldn't do it, rejected. Ran up again, hit it just the other day. And the trend line, just like the market short we had back a month and a half ago or so, November, it doesn't get any better than that. That is one of those things where I can say with absolute certainty that although I can't guarantee it'll play out a short trade, that is a very objective short. That is a 10 on a scale 1 to 10. When you see a stock that repeatedly gets rejected off a key moving average, and then not only that, also you have a primary downtrend line, and look how much energy was expended just to get there. There was a near vertical rip of about 24%. So to say that was near term overbought would be an understatement. That's it. It doesn't get any better than that. So Anywho, the move already happened. And again, I think that it happened. The drop was on a Friday, but there it is. Here's where we're at now. So we broke that trend line. That puts us on a near-term sell signal. That's bearish. In my opinion, there'll probably be more downside. And let me drop down to a 60-minute chart. There's that trend, a shorter term trend line that comes off the August highs, mid-August highs. We ran into that as well in the 60-minute chart, and you can see we had a divergent low that was a catalyst for that 20-something% rally. Ran into trend line resistance with negative divergence and a beautiful clean uptrend line. But that one, even if I had shared this setup, well, the setup would have been to short resistance. I always say there's one of two ways objectively to short a stock, either on a breakdown below a bearish pattern, sell signal, break down below trend line, or on a rally into resistance. So that would have been your entry, the rally into resistance. Normally I'd say with an add-on on a breakdown, but that gap down so far, it really gapped down to the first support level, and it's kind of just been consolidating there. So very near term, I don't know. I don't have, kind of missed the move on it, or at least a good chunk of it. It's down, dropped down about 8%. So where does it go ultimately? I think come down at least back down. I'm going to lower that line a little bit. This, by the way, this trend line right here that I had is support. Check this out. Look at the pop-up box. I created that line back on January 25th of 2013, a decade ago. The last time I modified it, that means I don't know what I did. I moved it, did anything, turned the color off, maybe turned the numbers off, but I haven't touched it or grabbed it or moved it since then, or it would show you the updated. That was back in January 26th of 2018, and you can see this is, it's since then, since 2018, 5 years ago, this thing has continued to act on that level, and I'll look at how many reactions, and I'll show you why. Big picture, Ford is a dud. It's when you look at the monthly chart, this is a go nowhere stock. It reminds me of the airlines. Forever and a day, airline stocks, if you've been an investor for years, they go nowhere. They go up, they go down, they make money, they make a little bit of, they're somewhat profitable. Their earnings ebb and flow based on oil prices and, demand and other factors. But you really, if you bought Ford, gosh, back in the 80s, you went up, you went down, you went up. But it's a go nowhere stock. There's no growth. There hasn't been for a long time. So this is just a trader's stock. Swing, or you can swing and trend trade. These are multi-year bull and bear markets. But at the end of the day, it brings it back to where it is, and it's right smack in the middle of its trading range right now. So I don't want to spend much more time on it. I just wanted to let you know that you can see there's the primary downtrend line. If you look at it from this weekly chart, we're in a bear market. That's all I can tell you. Although it's been putting in higher lows right now, my guess is before all is said and done, it's going to come on down here. But again, if it breaks that trend line, then maybe it does run up. All right, so that's it. I just wanted to cover it because there's a lot of interest in that. I probably spent more time on that one than I should have. I am now going to do updates on some of the recently highlighted trade ideas. And I'm going to explain kind of where I think this market's going. So somebody made a comment the other day. There was a big move in the Dow. The Dow dropped. And I've talked about this in recent videos over the last few weeks or months. I started highlighting some stocks on the S&P, and that's when I told you too that I favored the tech stocks, big tech, at least for just a rally, a bear market rally. That's it. I got out of those now with Tesla. Today was the last one. But what I think is going to go is, I was a big Seinfeld fan. My wife and I used to always watch that, and I know some of you do. And you remember George with his Festivus holiday. Festivus is a holiday for the rest of us, for those that don't celebrate Christmas or any of the other traditional holidays. And so I'm trying to think of a catchy rhyme, but I think what I'm looking at is a bear market for the rest of us, meaning the rest of the stocks. This bear market so far has been largely, I'm not going to say exclusively, but largely about tech, especially big tech. Tech has brought it down. That's where the layoffs have been lately, and so we know what's going on in Techville. But what's happened is, because of that, the Dow and the S&P have held up relatively well so far throughout the bear market. They dropped a lot less. The rallies were strong. But I suspect, as I said before, we're going to soon see a shift. In other words, a bear market for the rest of us, the rest of the stocks out there. So healthcare, that's one sector I highlighted. Those stocks have been very strong. Energy and other things. I'm going to go through some, not all. First, let me update, before I get to the components, I have a handful of charts, about a dozen I want to cover, and I'll do it fast. I know I'm talking fast. Let me cover some of the trade ideas that I highlighted just in the last week or so. One was O'Reilly. That's another, this is one of the rest of us stocks. This is a stock at all-time highs, bull market and all-time highs. This is O'Reilly Automotive, and you can see there's a nice clean. This is my monthly chart. You've got divergence building. It's been building for a while, actually. And so this is a stock that, bear markets, before they're over, they go out and they hunt down those that didn't get the memo early on. So these, there's a lot of fund managers that will target these because the relative strength is, when the market goes down, people look for the strongest stocks, saying they're doing something right. But I like to, after a while, early on, you don't want to start going after those. But I think now is the time. And obviously, you don't short a stock just because it's strong. Let me say that again. You never short a stock. You overbought, but can and often does become more overbought. You short a stock when you get sell signals. On this one, on the monthly chart, there it is. I love that 20-month EMA. That's that blue dash line there. It defines bull and bear trends. This was the last bear market in O'Reilly right here back in 2016 to 2017. Once it took out, there's our sell signal confirming close below the 20-month moving average. It dropped 34% from the sell signal, not from the high, but from the sell signal. We had one in COVID, but the very next month it told you get back in or close your short because you recover the 20-month. That is a beautiful thing. So watch that. And I like it even better because you have the primary bull market uptrend line as well, comes right in with it. So they both get taken out, and that's not a little swing trading 2-week 10% sell signal. That is a cyclical all-time bull market break of that trend line, and that's going to send this stock down, in my opinion, before all is said and done. Give you my target right there, 289. We'll call it 290 or 300. That would be a 63% drop. So this is what needs to happen. So then, that's a monthly chart. So yeah, you got to wait for a monthly close below. That's going to take a while. So then you zoom down to the weekly. You can see that uptrend line, the wedge, and you can go to the daily if you want to really hone in. And that's what, again, I gave you this one as a trade I did recently. So that broke, but I believe I would have said, if I didn't, I will say this, if I didn't say it at the time when I covered this a week or so ago, 802 is big support. See, just like, remember that basing pattern I gave you on the Qs that we broke above, and that was the cause for this strong January rally? Well, this is that in reverse. This is a topping pattern where we went sideways for a while and have been. We're still in it, building energy, and boom, if it breaks to the downside, it should be a very quick ride down to 780 right there, 781 for backfill the gap. That alone, from where we are right now, would be a drop of about, not much, but about 3%, and then boom, down here, first target, and that's where I would cover short and try to gain balance. That's 7.5% drop. And then you look, at the long-term charts. That's probably going to take us down to that trend line. That's where you'd bounce. The buyers are going to step in there. And so that's how I trade multiple time frames. This would be something like that, and then ultimately a breakdown and, stops along the way like that, and then ultimately down there. So these are the ones that have to die. In a bear market, if this is going to be the prolonged ugly bear market I'm talking about, you can't have a lot of stocks like this just ripping to new all-time highs. These are the ones that are going to come after next. And so I'm giving you both trade ideas and market analysis. Whether I short O'Reilly or not, it's something I'm going to watch. And that's not one of the biggest stocks out there. I gave you Airbnb recently as a long trade idea. That one was on a breakout above the downtrend line in the 91.39 level. If you took it, we're at that first target, which is 101. I have it at 191. So you made a quick 11% time to book profits, in my opinion. Get out. At least for a pullback, or at least raise stops. Maybe we power on through here, but that would be a very objective level to take it out. Just like Tesla, you usually hit these levels and you get a reaction. I gave you KHC recently, and I got a trade. Oh, there it is. Ooh. I had a price alert on this one fired in the morning. I had it at 9:30 exactly when the market opened, and this is a good example of why if you're serious about this and you have the time, your flexible work schedule or you trade full time, you have to use price alerts. This morning, this was one that it's down 5.4%. It's KHC, Kraft Heinz Company, so you can beta adjust this up. What I mean by that, comment that I replied to today, that person that you talked about, having the NQ or QQQ shorts this November also has natural gas. And I continue to say this because I know natural gas can be a widow maker. You have to significantly downsize your position to account for the above average gain and loss potential and the volatility. But likewise, when you short a blue chip stock or go long, like Kraft Heinz, you can use an oversized position, not crazy, but maybe 1.5, 2 times what you might put in Apple or something like that. And look at that. This was a beautiful entry. The alert went off this morning, and you had plenty of chance. It's not like it gapped down. Those are the ones that I don't like to chase. If this thing gapped down 5% today, no. But that was a beautiful short entry, and again, it was laid out in advance. I do my best to get these trade ideas in advance, and I didn't give you a target when I covered this one recently, but give you the trend line. But now I'm going to give you a target right here. Boom, right there. This one will fall to $39, just above there. Buyers are going to step in, and I would cover that. If you caught it today, I would cover that. It's not a monster trade, but again, if you overweight a position, it's almost a 7% drop. Then that equates, if you had a double-sized position, that's close to a 14%. Quick, and this is so far one day. And this is the nature of this beast. And look, this is technical analysis. I always say it's all about this. There are no guarantees, but it's just about recognizing previous similar chart patterns. That's how it evolved. People started noticing that stocks at times had predictable patterns when they did one thing or another, and that's where all these head and shoulders and cup and handles and all these bullish and bearish chart patterns came from. And you can see this one it's the nature of this beast. It did that last time and must have been earnings and fell off a cliff. So for whatever reasons, just the how this stock tends to trade, and you can see it here. And I think I would have laid out at least one, if not both, of those short entries. There was another breakdown of the cleanup trend line. So, it's simple stuff. And this is where mom and pop buy and hold investors get killed. They're buying a stock like this for a dividend. And over the years, they find out they're up a little, and then they're down, and they've lost more in that year than they made in their dividend. Then it goes up, and they're happy, and they're back and forth, back and forth. So, anyways, that's why I swing trade, and more often than investing. All right, next up. I'm not going to cover them all, just highlighting some of the ones I highlighted recently. I give you a Line Tech, AL, GN, told you those on one of the tech. Oh no, this is a medical device breakout there. Not sure where exactly. I might have highlighted it here recently. It's been running up, but it just hit that 200-day moving average, and then it has price resistance just above it. So it might be time to, and it's very overbought, to tighten up stops on that one if you're holding out for anything more than that 200-day. CRM is poised. If the market can rally, now it's at resistance. You don't buy a stock at resistance. That I can tell you now. But it's poised. Probably get a pullback, and it may not break above the trend line. But if it does, especially after a little consolidation and pullback, that's a bullish pattern right there, because you have big divergence. Again, I highlighted this one just this week or last week. Positive divergence at the low and a downtrend line. If it pops that downtrend line 166.55, it's probably going to take the market in the tech sector to rally some more to get that. And then finally, let's see. Yeah, we've got time. We're okay on time. I'm going to roll into the Dow components. I went through, with this TC2000 charting platform. What's nice about it, when you queue in an ETF, you get a list. You can't see it. It's cut off on the screen. I'm only recording part of my screen. It has a list of all the components, and I have those sorted by market cap. I'm not going to go through each and every one. There's 30 stocks in the Dow, but let's just go through. We'll start with the top component, Apple. I've covered that extensively recently because it was a trade idea, and I started out in the video covering it. But here's what I want to show you. Long term. There's a lot on this chart. Let me just turn off the lines, or let me first draw it and then I'll replicate it with the annotations off, all the drawings and everything. That's our primary bull market uptrend line in Apple. It comes off the '03 lows. That was our last, not our last, so that was a bear market after the dot-com bubble. The market and Apple bottomed out there. And I just got a price alert on Apple. Let's go check that out. That must be on the short term. Oh, was that trend line I told you? Okay, sorry. Got a little distracted there. So there it is, the weekly chart. I turned off all the lines. Keep in mind that Apple is at that long-term support. And now I'm going to talk a little bit more about long-term. So I'm going to turn back on the lines. What makes me think the bear market's not over? Well, one, but not everything here is all this divergent high. Yeah, I know it's hard because I have so many lines in Apple, and I wish I had a cleaner board to show you. But that is negative, big divergent high here on the weekly chart, and you might not be able to see it. This says DH here. I'm going to just read and highlight and circle all on the weekly time frame, which is a longer term trading, swing trend trading time frame. I'm giving you the drops that came after all the divergent highs. 35%, 39, 34, 45, 16, 15, 26, 62 back in '09, 42. And so far, and I like to do this, I have longer term targets. So far, Apple, the leader, biggest stock in the S&P and NASDAQ, has only dropped 32. And based on the scope of this divergence and everything else, I think there's more. And if we break that primary trend line, there's going to be quite a bit more. And I have an aggressive target. I know I would get laughed off. I don't. I have no desire to ever be on, TV, CNBC, Bloomberg. They put me on because I'm not promoting anything. I do my own thing. I don't manage money for others other than family members. So, but if I went on there, they'd laugh me off if I even showed them these targets. The 82. Yeah, I think this will be, and this is not anything we're going to see this year. Or maybe even next, but I think that's ultimately where Apple's going. Near term, if big if we just hit trendline support. So again, you can make a case, as I just did. I just went long Apple, a week or two ago, a couple weeks ago, 2-3 weeks ago. You can make a strong case to buy it here in a bull market or the primary trend on Apple. Forget about the fact that we're in a bear market. Apple's not, at least not by most metrics. It's in a powerful secular bull market, relatively speaking, not far off its all-time highs, and it just pulled back to primary uptrend line support. So a case can be made there to buy it. However, that's the glass half full, and then you could buy it and you have a stop below the recent lows. The RR is very good, even if if the trade doesn't have the highest probability of playing out. Now, if it breaks, then that's a very powerful sell signal. So this is a weekly chart, a solid weekly close below there will increase the odds we're going down to, well, my next target on the weekly is about 118.20 to 122.20, so we'll split the difference, call that about 119. It's more of a zone. No, I'm favoring the bottom number. Yeah, I think the 118.20ish is where we'll go, and then ultimately, 105.50, and then all the way down there. And when you look at the monthly chart, again, I have the same thing here. These are this 30-year plus chart, 30-plus year chart highlights the cyclical bull market tops and bottoms, as well as the primary uptrend lines which defined each bull market. The percentage of each drop was calculated from the previous bull market peak to the bear market trough. So here's your bear markets. 59, 70, 74, 83, 42, 62, 45, 34, 39, and so far I did this back on June 30th. What I just did so far, only 29%. Yeah, highly unlikely. We're in potentially one of the worst macro environments, meaning macroeconomics since the 70s. All right, we have not had runaway, and that's what we have. Runaway inflation. There's been a brief abatement since then. So, anywho. That's all I'm trying to say. It is very unlikely the bear market in Apple is over, and this is big support on the monthly, and we're flirting with it. We have been for the last, actually, since all the way back in June. We hit it there. Nope, I lie. We hit it the month before that. We hit it in May, June, July, had a little rally, September, October, bottom that candle right there, November, December and January, here we are. So, all right, guys. I know these videos go a long time, but there's just a lot of moving parts, and this is what I do. Really dig deep down and look at not just an index, but as many of the components that matter that make a difference in that index, and that's these big guys. Microsoft monthly. I'm not going to go over every time frame. There's our we had first this uptrend line. That's what helped confirm getting short, early on in the bear market last year. That trend line broke after the divergent high, sent us down to this next trend line here, which since broke. Right there, I'm trying to, well, you can see it. We're below it, and then we took out that. Gotta love it. That 20-month exponential moving average right there, a solid. We flirted with it for a few months, and then took it out. And again, I employ you to try to find a better trend indicator overall in the market and most leading stocks. And look at that, since for years now, all the pullbacks to that level have contained that level has contained all pullbacks in to find the bear market, especially on a monthly closing basis. And that's it. And once we broke below it, back test, fail, and now we're starting to move down. And where to? Well, nobody wants to hear it, but I don't see really good support in Microsoft until we hit that larger primary uptrend line, and that's going to be, if and when we get there, at least a good 40% or so downside from where we are. And that's going to have a big impact on the market if that is the case. Oracle, I didn't mean to even do that, but there's Oracle, another trend line I wanted to go to. I just have a handful. And I'll go on different time frames. Travelers, these are the rest of us that have to get taken out. Travelers that just put in an all-time high, but then you can see here, this is just a daily chart. This is again one of the S&P 500 and Dow stocks. Big red candle, solid sell signal, and that's how bear market. These stocks that are the last holdouts, that's usually how it starts, with a big bang, a big red candle like that breakdown I showed you on, what was it, UNH today, whatever, what that first one, KHC. Because what it does, it traps the bulls in, comes down so fast and denies the shorts, and then that creates for a better, more lasting downtrend versus an easy out, because they're trapped in there. They're waiting for the bounce back to just get back to where they were. That's where they'll sell. They realize, I rode this one too long, but it's not going to give them that. So anywho, I just want to show you that this is the Dow. Some of those leaders are starting to finally break down. UNH has been one I've been eyeing for a long time. United Healthcare finally broke down, one of the big healthcare stocks. Broke down, took out the 200 days and the trend line a few weeks ago, and still headed lower, and in my opinion has a lot more to go. This is another one that recently put an all-time high. So here's my theme. Those last, the holdouts in the S&P are finally we finally have sell signals, finally have a reason to short those and make a case that they're going to drop, and the rest of us are going to now join the bear market that tech stocks started over a year ago. JP Morgan Chase, bearish rising wedge, hasn't cracked yet, but very close. Negative divergence tell me that it will probably crack soon. And first stop in this one is going to be 127, and then more. Walmart, big one. WMT. There's a daily chart right there, an uptrend line, but I had a note to show you the monthly chart to kind of paint the big picture. Here it is. Okay, this is the big picture stuff. This is just, I don't hear many. Again, I kind of live in my own little bubble. I don't watch much TV. Don't follow many. Really, I don't follow any one person that's in this business. But I don't hear many people talk about these long-term charts. And to me, this is our very long-term trend line. We had one here, a trend line there, that when it broke, Walmart didn't go down, but it also didn't go up for years. This was about, from 2000. The stock bottomed out in the 90s, just went sideways in this range for a while. But then it finally broke to the upside, which was bullish, and that's where it sent us here. But look at this trend line. I mean, that it does come off those lows, but look how well it picks up here in 2015 as well. It's the same trend line. And then you zoom in, and what happened? It broke. There was our breakdown candle. Confirm, and we've been back testing it from below. Just need to take out that 20-month, and that's what would likely get. We'll get a breakdown, back test of the trend line, and once we get rejected, if we do, and again, I gave you the trend line start out with on the daily chart. That would be what it looks like on the weekly. You break that, and that's where Walmart's going, 105.50. And that's going to be a drop of about 25% with a first stop. Now, might check the recent lows, maybe, maybe not. 118. All right, what's up next? Procter & Gamble. Again, I'm looking at blue chips here. Procter & Gamble. All right, so this is scroll back as long as we can go. These are when these stocks, a lot of them, this one I have history back to the 80s here. There's our primary bull market uptrend line. It broke here, and we've been back testing from below since. We zoom in a lot closer. What needs to happen to this one to get the party started on the downside is a break below 126. See that 26% drop? Why I put question marks there? Why did I do that? Well, we've had the last, going back for, well, I didn't go back to the 80s. I went back to the late 90s. We had two clear bear markets in the stock. This one was a 55% drop, and this one from high to low was 48%, right? And we haven't had anything like that since. This one's 26. 26% if in this environment, if the consumer rolls over, and I meant to talk on that earlier. Yes, we had some, mixed signals on the reports this morning, but basically the evidence is the consumer is slowing down. Consumer spending was down, and that is the most important thing. Remember that consumer spending accounts for 2/3 of GDP. All right, so a lot more than government spending. Government can do all they want to try to stem the economy, but when the consumer finally tucks in, and evidence is showing that's what's happening. So what you're seeing lately, market's been getting giddy and rallying. Even this morning had that early pop because of the weaker PPI data, the producer price index, which shows inflation maybe still abating, but then it's facing the reality that, hey, inflation can go back to nothing. We can go down to zero inflation, but if the consumer rolls over and stops spending, the economy is going down, inflation or no inflation. And so that's it. I just want to point out, this is just, all these look like you have a sell signal here, back to right there, moving lower. And if and when 126 goes, we'll go down at least to that 94.30. Get a bounce there, and but now you've also rolled off the big primary uptrend line, and then ultimately you can go on down here. So this is what needs to happen. These are the things I'm watching, and as I've covered in here, I know the video is getting pretty long now. Quite a few of those stocks that have held up have finally started to break, and those that haven't, you have clean uptrend lines like CVS, Chevron Corp. This is a weekly chart, bearish rising wedge. There's your trend line. There's your 200 days. When it breaks, this one rolls over. The Dow and the S&P are going to roll over as well, right? Caterpillar, there's a big one as well. Kind of tells how what the health of the economy is like. Daily chart, that's what I wanted to focus on. Negative divergence, pretty steep and clean, the way I like to see it, with those clean separation in the peaks there. Uptrend line, that is a bearish rising wedge. Break that, you're going to have a sell signal on CAT. You don't have it yet, but that's a trend line. Set an alert. And then it's simple. The more of these that haven't broken, the more that do break down and join the party, the greater the odds are that we're going to have another leg down in the bear market. If they don't, maybe they hold support, then maybe the next big drop gets postponed. Boeing, daily chart, bearish rising wedge, uptrend line, which to break and trigger sell signal. Negative divergence says that it's likely to happen soon. 3M, what did I want to show you on 3M? That was not bad. It came off, positive divergence right there, divergent low rally. But when you look at, kind of just go back to a weekly chart or monthly chart and look at the big picture. Here's a stock and a bear market. The stock peaked back in 2017. Had a bear market, then it had a bull market, and now it's clearly in a bear market. Lower lows and lower highs. And it keeps getting rejected, as you can see off. These are the 200-day moving averages. On a weekly chart, that the 40 period, or 40 week, boom, boom, boom. So now if it takes out the 200s, that's usually a bullish sign, unless it's anything but a whipsaw like that one. And Travelers, TRV, another one right off all-time highs right there. Bullish, bullish price action lately, but this is a weekly chart. Negative divergence has been building, 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 and then started building here on the RSI. And so that one looks like it's just a matter of time. And then to hone down on an entry, that would have come yesterday on this break below the trend line. So again, another one where they're exiting quickly. You know, these are stocks that are at nosebleed levels. Maybe not necessarily valuation wise, but just trading at the all-time highs. And again, the bears, they hunt. They go out and they hunt these stocks at a certain point. And I think that point's coming now. So that's where I'll wrap it up here. And that's what I wanted to show you is that, hey, you know, so far this bear market's largely been about tech. And if we watch some of the more stable companies, it's a tell really for the economy that now, you know, those that were kind of immune from the whole tech thing, they're starting to crack. And again, it's the technicals that will tell us that. And the news, the headlines will follow afterwards. Why healthcare stocks are falling, why the insurance stocks are falling. But like I said, sell signals on quite a few of these. You can take them as individual trade ideas, or like I do, take it collectively and then incorporate that into your analysis on the equity markets, both long term and even shorter term. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great